portfolio manager for whatever amount of money you have. I think the majority of people out there, 95% of people out there, will be shocked at the amount of money they waste on things they don't need. Starbucks, coffees, things.
Better value for money.
Yeah.
Or more, let's say, a more institutionalized and professional approach of how you need to manage your finances versus your emotion.
Yes.
I'll give you one example, which I think it's worthwhile saying. When I used to meet with people to draw up their economic profile and advise them of how their economic basket should look like, I always used to take a pen and piece of paper and draw a circle and said, tell me about your investments and what kind of investor are you? And there was this guy that said, oh, I'm a very risk-averse investor, very risk-averse. And I'm like, okay, so you have everything in cash? No. I'm very risk-averse. I have X amount of money in shares of Lagi Bank. I have investments in Romanian real estate. I have 200,000 in cash. I have this, I have that. I forced him to put everything he owns, liquid, illiquid, all types of assets, shares, and non-listed shares, in terms of money value, and to put it down outside his house. I forced him to do it.
Yeah.
And he actually enjoyed the process. By the way, I did that with all my clients / friends that I had to advise. And when I put the numbers down in the pie chart, he freaked out. I said, look at this pie chart. You say you're a very risk-averse investor, and 50% of your wealth are in like one institution. May that be in stocks, may that be in deposits. You're in Lagi Bank. That was before it crashed, huh?
Oh my God.
Before it crashed. And I said, you think that's risk-averse? What happens if and Lagi Bank crashed?
Did he make a move?
He made some move. He was a bit shocked. He made some move. But he insisted in saying that I'm a low risk investor, and he had like 9 million in Lagi Bank shares.
Oh, goodness.
And he moved some money. We moved it into like funds. We moved some money. But when Lagi Bank crashed, he called me and said, Demetris, I should have listened to you. Demetris, why didn't I listen to you? Why? I said, I'm not going to say I told you so, but all I'm going to say is, like, don't blame yourself. You and 90% of the rest of the people are governed by emotion. And because, emotion will never give you the right result. You thought that, and because that's what you knew for 100 years, the banks are there for 100 years, will be there forever. And that's emotion. You when you invest, you need to remove that and just think, what type of investor are you? You're risk averse? Go put your money in a money market fund. You won't get 8% interest because that's a very high interest, and there's no free lunch in economics.
Yeah, there must be a reason.
Which means that there's more risk than you can tolerate. Put it into a money market fund. Put it in US Treasury bills, and that's it. Risk averse means 70% in spread in like 100 places in low risk stuff, and be willing to not have return. You can't want return and call yourself risk averse.
Right.
There's no free lunch. And that's the major issue that I see in most people. They wake up with a bad decision years later because they were ill-advised, or someone said something to them and that was stuck in their head, or that's what their family did. I'm a family investor in this company.
Yeah.
So what? It's like, unless you control it, where there you control your fate, Warren Buffett style, you need to decide what type of needs you have. And read get professional support.
Yeah, I think also people get stuck or get off track by information bias, so they don't have enough information at their disposal, not enough access, and then also believing, like convinced on some information or status that just may not be true, like in this case of this investor where he strongly believed, it sounds, that he was risk averse, right?
Formation bias is a very good word, the phrase that you're using. Information bias. Euro USD. Let's go and ask 100 people out in the street, or 100 of your traders, your followers, which are much more clever than me and follow the markets much more than me. They will all give you a different reason of why it will go up or down or stay the same, right? Yes. They will all give you a different reason. Now, what is safer? What is safer? To do the research yourself and rely on your own process of information, which might be too late, inadequate. You might not have the processing power to process all that information, which you don't as a human being, and you don't control it either. Versus going to Bloomberg, seeing what all these clever analysts write about and taking the average.
100%.
Are they going to be right? Not all the times, but at least the average should point you to a better direction than what you're going to decide. If you're lucky and you get it right once, 2 times, 3 times, but on average, it's all about expectations. What people don't understand is that investing in transferable securities, what that may be, CFDs, indexes, stocks, bonds, whatever, it's expectations. And expectations are governed by emotion, are governed by uneducated people or people without enough information, or people with not enough power to process information, or it's expectations. And the best thing you can do is get a reflection of market conditions through more people than less people, so that you're closer to the expectation of more people. The markets is a mirror of the expectations of what people have in their head. And as I said, if you ask me, I'm going to have a different view from you, or not agree completely. And it's the same with everyone else. It's too many variables.
Thank you for watching. If you liked that video and you want to watch the full episode, it's available here. Remember to like, subscribe, and share. It helps the channel.